Hey there folks and friends, Connecting Dots here. It's Monday, May 7th. You're taking a look at the spot price of silver, $30.07. Boy, what a great opportunity. Anyhow, I've thrown together here a few clips. I hope you enjoy them. Hope you pass them along to other people. You'll want to pay special attention to one of them where they talk about India and China now starting to pay for oil using gold bullion. That's the largest trade deal in the world where they're now using gold bullion. It's the USD is in big trouble here. I hope you pay close attention. Things are about to change this summer. This is it. Also, I forgot to add one little piece of information. The very last clip you get to listen to is an interview with Board of Directors members Adrian Douglas, where he talks about silver will overtake gold in the near future. Anyhow, pass it along. Hope you enjoy the info. Take care, folks. Load her up. Lock and load, like Jim says.
There's this blue line underneath the price, which is called the 200-day moving average. And there have been 7 times where the price was below the 200-day moving average. And the reason I consider these big buying opportunities is if you look at it, once the price starts to rise and it rises above the 200-day moving average, it never comes down to that price level again. So you're buying at a low, and right away you're in profit, and then you never see losses on that purchase. And there have been only 7 opportunities to do this, and you can see there's been a pretty long gap here, and we're at the 7th opportunity right now. And then I'm going to zoom up now on the last 3¼ years here and show you a close-up of that. And what you see here is this support line, this trend line, that's giving rock-solid support. There have been 1, 2, 3, 4, 5, 6 hits on this support line. And then there's a trend line at the top, and when you put these together, this is called a triangle or a wedge or a pennant. And it's a symmetrical triangle, wedge, or pennant. Now, a symmetrical triangle can break either direction, but it usually breaks in the direction of the previous trend. So this is all very, very good news, and we just bounced off of that support line inside this triangle. So it could go up, it might bounce down and come back down and touch that trend line one more time, and then we're probably off to the races. But if it does come down and bounce off that trend line, it's probably going to be at a higher low than today's price. So in other words, you won't even see red on this. So I believe that it's a very good time to buy. And then another pattern that I saw in this is that there's this dip makes a shoulder, this makes a head, and another shoulder. Head and shoulders patterns work whether they're right side up, whether you've got a shoulder, head, and shoulder, or upside down. And they're one of the most reliable patterns in technical analysis. They're correct about 60% of the time. And it's not a completed head and shoulders yet, but if that trend line holds and the price moves up, it will be. And what happens is when the neckline is broken, these 2 peaks up here of the inverted head and shoulders would be the neckline. When that is broken, you can take that head and sort of flip it upside down, and that's the predicted move, and it's predicting $2,100 gold coming up here shortly. And then I took a look at silver, and silver has the same head and shoulders pattern going on. Now, I always analyze gold first because gold tends to drag silver around with it, and silver is such a heavily manipulated market that it's really hard to analyze because the charts have all of this man-made data in it where it's somebody is manipulating it. But what I see here is that if this head and shoulders pattern works out, if it rises and breaks the neckline, you flip this upside down and you've got basically $44 silver. And then it runs into a resistance level of this previous peak. And so it would probably do a little pullback from there. Well, if it does, then there's another bigger head and shoulders. This entire head and shoulders pattern becomes a head. This dip becomes a shoulder. So if it did a pullback and started rising again, you have another head and shoulders, and when you invert that, you'll end up with about $60, $65 silver, and I sort of find that exciting. So it's double the price range of where we're at today. And that usually happens pretty quickly.
They move vaults. They physically move vaults. All right, so Brinks in that week moved 386,000 ounces from the eligible column to the registered column. All right, so that's 386,000 ounces available for delivery. Okay, and this is interesting. J.P. Morgan Chase moved almost 5 million ounces into a deliverable position. Okay, from eligible into registered. All right, J.P. Morgan, week ended April 27th, moved 4,991,883 ounces into delivery. Where this means no one's tendered on it yet, but if someone does tender on it, say they want this, okay, JP has it available to deliver. Okay, now it's a bit odd to me that they would do this. All right. Perhaps they've got a big customer, a big Govy customer lined up. We spoke about a couple of weeks ago, Mexico, Russia, and China. Well, China numbers are hard. You can never get hard and fast numbers out of China, but particularly Russia and Mexico and Turkey were big net buyers of gold in March. All right. So, perhaps JP is just preparing for that. So, based on this analysis and what JP has done, all right, it's very hard to say, accurate forecasting going forward. But what I would offer to you is that when you see this kind of volatility, if you will, these huge shifts from deliverable to non-deliverable physical, it's usually indicative of an upcoming big move, quote unquote, big move. All right, so, lock and load.
Let's go over here, and I brought along a little chart, a little pie chart. This shows how silver is used, the demand for silver. 35% industrial. You got some photography, which is declining, jewelry, silverware, coin, and then ETFs at 55%. Now, that's not that interesting. What is interesting is if you look at what the total is, it's 127%. In other words, there's 27% more demand than there is supply of silver, or a third of the silver market. That is exactly what the Hunt brothers were able to do. They bought about a third of the outstanding silver market. So if we look at our chart here, this is silver from the 1970s. This is spot silver, 1970s to present. During the 70s to the Hunt brother peak, silver went up 3,500%. If we take that same math and saying that 30% of the silver market is a shortage, and we go from the mid-2000s and we say 3,500%, you get a silver price of $130. I don't know if it goes there, but I know at $30, this trade isn't over yet.
Another interesting thing to note here is that if Beijing and New Delhi continue to trade with Iran with gold, it's actually going to increase the value of gold and decrease the value of the U.S. dollar as the global reserve currency.
So is what is good for gold the same for silver? Would you say that the upside potential for silver is equally as good, if not better than gold?
Yes, silver, I think at some point in the future may actually trade at a higher price than gold.
Really?
Yes. The reason for that is that, silver has been abundant for a long time, and in the earth it's 13 times more abundant than gold. But we consume silver. We don't consume gold. Gold, almost all the gold ever mined in the world in human history is still above ground somewhere. But silver has been suppressed in price, and it's so cheap that we don't recycle it, or we don't recycle a large quantity of it. The silver that's in your cell phone battery or on the connections of electronics or in solder and these sorts of things, it ends up in landfills. And so we are taking silver out the ground and consuming it, and it's lost forever. And because we've been doing that for 50 years or so, the amount of silver we have left is getting less and less, and silver is becoming more scarce than gold. At the same time, silver is gaining traction as an investment metal again, and I think you put those two together, and you've got an explosive mix, which means that silver will have to trade at something which is higher than the gold price at some point in the future.